The stock market continues to make record highs, and I don't think the reopening trade is over just yet. In fact, I think there's a select group of stocks that have a lot farther to run. For those that are pessimistic, well, those people have been pessimistic for a long time, and they've missed participating in over a 60% gain in these reopening stocks just over the last 5 months alone. So despite this run-up, I think there are still select stocks that can do extremely well. And what I'm going to give you are some specific examples of stocks that I think that can do well. However, I want to emphasize that it's not just about these stocks. The opportunities are limitless. And so rather than just focusing on a handful of stocks, I'm going to provide you with some general types that these stocks represent. Because as the economy opens, these stocks are going to appreciate, and that's what you want to look for to invest in. And so far as our first reopening type, let's start with a stock called Dentsply Sirona. Its ticker symbol is XRAY, X-ray. This is a company that sells consumable products and services specifically to the dental market. Now, think of how many people you know that over the past year, because of COVID, have postponed visits to the dentist. That means that there's extreme demand, pent-up demand, that's going to occur once the economy fully opens. And this company, I believe, is poised to continue its run-up. Now, it's already up about probably 40% in the last 5 months or so. It's back to its pre-COVID levels. But some earnings estimates have this company earning as much as 25% a year for the next several years. And that's because although their business has been impaired over these last 12 months, they've kept a strong position, a strong leadership position. They're improving their operating efficiencies, and their market dominance has increased. And so I think this stock is an example of one that has a lot farther to go. Another one, which is very similar, would be the stock called Performance Food Group. That's PFGC is the symbol. And this company operates as a full-service provider of consumer foods and related products to the food service industry. They, unlike XRAY, have been able to stay open over these last 12 months, and they've done pretty well at earnings. Their stock prices reflected that, and that's because they focused on the restaurants that have stayed open. So primarily on the fast food, drive-through type restaurants. And by serving that particular segment and performing well, they too have increased their dominance in the market. They've solidified their leadership position. They've cut back and reduced in terms of improving their efficiency. And now where they're poised to go is to not only be able to excel and appreciate as more restaurants open up, but they're going to be able to really specifically focus on those sit-down restaurants, the more fine dining restaurants, and then their overall dominance should continue to grow because areas that have been totally shut down are going to be reopened to them. Those are things like school cafeterias, hospitals, sporting events, and all types of recreational vehicles. I think Performance Food Group, although it's done extremely well, I think it can go a lot farther, and there are estimates that have their growth rate as high as more than 50% for the coming years. Now, another stock type is Lyft. That's ticker symbol LYFT. It's the ride-sharing company. Now, Lyft was severely impacted during the COVID shutdowns. It has recouped its price. In fact, it's exceeded its pre-COVID pricing, but it has still never gotten back to the 2019 IPO frenzy type prices. In fact, it's never even gotten back to the initial consolidation point of that 2019 IPO. This is a growth momentum stock that wasn't favored like some of the other FANG type stocks that did so well during the stay-at-home episodes. So I think that because of its leadership position, the fact that it really capitalizes on a lot of type technologies, has a lot of growth and momentum behind it as a fairly recent IPO, that once these COVID restrictions are fully lifted, that Lyft is going to fare extremely well, particularly once those big urban city areas have reopened. Now, finally, this last stock is it's an ETF, and that's Brazil. So Brazil Exchange Traded Fund with symbol EWZ. Now, I wanted to include this because although I am really focused and concentrated in the United States economy, I do think that there will continue to be areas overseas which should do well once COVID is fully reopened. And I think Brazil could really be a poster child for an economy that's been beaten and battered down and still has a long way to run. So they've never gotten back to the pre-COVID highs. They're significantly off of their previous multi-year highs. But right now, despite this big long consolidation pattern, they do look like they're forming a very favorable hook and bar pattern. And what we have to remember about Brazil, the worst is probably not over there. You know, they're just going into their traditional flu season. It's going to be winter over there. And so things will likely get worse before they get better. Now, I don't know exactly where the bottom is. I own this stock, this exchange traded fund. I own it. It's part of my portfolio. I'm not trying to buy it at exactly the lowest point. I think that this is a great entry point to get into it. And that, remember, eventually this virus will be restrained. As I've always said for the last year, COVID is a virus. It's not stage 4 cancer. It's something that the U.S. economy is getting over right now. The world economy will eventually get over it. Brazil, I think, is poised to really take advantage of that because once it does fully recover, it will return to being a commodity export-led economy, which should prosper as these cyclical type stocks rebound. So there you have it. Those are 4 stocks. And what I want to reiterate here is that this is not just about a handful of stocks. I think that the reopening economy has really limitless opportunities, and that's why I personally don't own just these 4 stocks. I own something in the area of probably about 138 different individual positions. So I'm a huge believer in diversification. I think you should be too. I think that's the prudent position to take. And if you'd like to stay up to date and know exactly what I'm doing with my trading, you can do that by following my free blog notifications over at my firm's website. That's investablewealth.com/commentary. And then also, please continue to listen to the Wealthsteading podcast that's available wherever you syndicate your podcast. It's a long format audio explanation and commentary of what I'm doing with my personal wealth and where I see the market going. You can find that at wealthsteading.com. And then, as always, hey, thanks for watching. Until the next episode, this is John Pagliano wishing you the very best returns.